Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today is Monday. It's July 10th. I had a wonderful, wonderful weekend. I want to thank everyone for the wonderful emails. And I hope everybody got their email back from me who asked me questions. I get a lot of emails over the weekend. Now, let's do some housekeeping before we begin. Make sure to like this channel on YouTube, subscribe to the Wealth Press YouTube channel, like our videos, join our Telegram channel. If you don't know where, just click the link in the video, below the video. Or go to rogerscott.com/Telegram. And the most importantly, I've opened up my VIP room at noon today for the summer for a lot of folks who are interested in the CPI, in the earnings, and all that other good stuff. And I'm giving hot free trades. Don't miss out. The link should be below or above this video. VIP room, noon today, Eastern time. You do not want to miss out. And that way, it gives you a good chance to review this video and then ask me questions about things in the VIP room at noon today. Again, the link is either below or above this video, whether you look on the page or the YouTube Wealth Press channel. Well, let's get into it. What are we wasting our time for? I've been already talking for a minute here. All right. As you can see here, the Nasdaq is opening down. The Dow is up 35 points. This is randomness. I mean, the S&P is down 0.75. This is not this is not a strong amount of stability. This is random trading action. However, with that said, look at the Dow Jones. And yes, I've mentioned it. I said it. To give you a review, I told you about 3 weeks ago that industrial stocks look like they're topping out around here and they're going to come back into the range. I also explained that basic material stocks are coming down. They're coming back in the range after they made a high here, which made the Dow look a little overbought, especially given the fact that it's been doing a great job of bouncing between these levels right here. So you could see right here, we're just continuing this trading range, and it appears to me that we're going to take a little dump down. And that makes a lot of sense because earnings are on the docket, and we've had some upside moves after earnings on the tech stocks, and I don't think earnings justify that. So I think we're going to be seeing some downside on that. So expect more downside on the Dow due to industrial and basic material stocks being wanky. What about the Nasdaq 100? Well, remember I told you guys I think it's going to go up, pretend that it's going to break above this level, and then start coming down. Well, the problem now is there's really no major catalyst for these chip stocks, and we're seeing some international pressure with chip stocks, which, as you could see right here, is doing very, very similar. This is look, this is the 3-month action on the SMH, the semiconductor index, and this is the QQQ. And you could see they look virtually identical. Well, to me, it looks like chips have peaked out, at least for the time being. That's going to put a lot of pressure on technology stocks. And as I mentioned to you before, several times, momentum levels on the Nasdaq is starting to come down. Look at the number of stocks trading above the 50-day line. It's coming down. It looks like it peaked out around here. Look, see that? Doesn't look like it's got more to go. And if you look at the 20-day line on the Nasdaq 100, which I'll show you right now, looks like it's going down. So if the 20 days going down, the next is the 50-day, and the next is the 100, 150 to 200. But the point is, we're seeing some major sell-off. And unless there's a huge, huge catalyst, which I'm not seeing this week, especially with the CPI, we're going to have a problem. Now, that's the first thing and very important thing I wanted to tell you. So keep your eye on volatility. There may be some more upside. We may still have some firepower. Also, keep your eye on the bond market. I think the bond market is a little overdone. I would maybe encourage a small position around these areas, but I think the bond market's also overdone because most of the downside is priced in the bond market. There's just not that much news in terms of interest rates. We kind of know the direction the Fed is taking. Now, what's the most important thing this week? Well, we've got earnings starting on Thursday. Yes, earnings. And I'll post this page for you on my Telegram channel. You don't even have to ask for it. I'll get it to you in a couple of hours. But you could see Pepsi-Cola's coming out with earnings. They're looking at a little higher number. Delta's looking with earnings. I think the numbers are going to be great. They're with energy, especially with energy prices lower. But you could see here, Conagra's coming out, Progressive, Fastenal. So we do have earnings, and I have the year-over-year expectations on EPS and revenue right here as well. So you could see exactly what's going on. On Friday, oh boy, that's when the floodgates open. You've got JP Morgan, you've got Citigroup, Wells Fargo, and then it starts off really hot in BlackRock, United Health, and then it starts out really heavy. You could see right here what the projections are for JP Morgan on Friday. And again, I'm gonna link this and I'm gonna post this for you in the Telegram channel, so you guys will be able to. I'll do it in a little bit after this video, but I'll go ahead and I'll link this so you guys will have this for the week ahead. There's also a couple of other things that you need to have, and I'll give you that. But keep your eye on the bond market. I think the bond market's going to turn around because we're going to see flight to quality as Nasdaq stocks start coming down and volatility could stay elevated and bonds start reverting, because I don't think there's that much unknown right now. And I think with the economy getting slightly worse, not better, the Fed is going to play the let's wait and see what happens. They still have plenty of time to raise rates this year. Don't you worry. They got plenty of time. Now, let's talk a little bit about what we've got this week, and then I'll put it all together and in a bow tie for you. So today we've got Fed speakers, and I'll talk about that in a minute when I do my broad review. Tomorrow you've got small business activity. Here's the big daddy, the CPI. And this is the big daddy. This is going to determine how the markets are responding to the Fed's actions. And then you've got PPI. What we want to see with the CPI, we were looking at the core. We do this all the time. We're looking at year over year, and we're hoping that the number is below 5.3. If the number is not below 5.3, we're going to have a problem. If the whole number, not the core, the whole number is not at least lower than 4, preferably 3.1, it will be better. But we're looking for these numbers to decline, not ascend, but decline. So that's going to be the big number, and I think the bond market's going to really want to hear that, because if the number is a lot better than expected, then there's a good chance the Fed will say, well, we'll hold on further, because we already have priced in that they're going to do a 1/4 basis point. But the futures are pricing in no future rate hikes this year after that. So I think it's going to be a very telling sign and something we need to pay attention to. Now, let's talk a little bit about the broad market, what we can expect today fundamentally in terms of global economy, and then I'll get into the nitty-gritty with you. So weak inflation data from China added to a gloomy global economic outlook while investors look ahead to the latest U.S. inflation data and earnings. Here, Friday session, the Dow dropped to a 1.5-week low. Levi's was down. Costco was down, which is not good at all for the economy. Bank stocks were up. And remember, with bank stocks coming out, we may see some volatility in financials, especially towards Friday or Monday of next week. U.S. Labor Department reported Friday that they added 209,000 jobs, lower than expected, and a big whiplash based on Thursday's private report from ADP that showed the number was like over 400 or some crazy number like that it doubled. Those numbers have not been in line with expectations at all. The ADP has been very inconsistent. So 209 is really not a great number, okay? Big banks, including JP Morgan, Wells Fargo, Citibank, are kicking off their earnings later this week. U.S. Secretary Janet Yellen acknowledged the possibility of a U.S. recession in an interview on Sunday, noting that it was appropriate and normal for growth to moderate and that inflation remains too high. I'm going to tell you something. I was looking at stocks this weekend. We're looking a lot like we did in 1987. I'm just letting you know. We're looking a lot like we looked just before we started a major downturn. In the coming week, as I mentioned, we have the CPI data. We've got the core PPI, PPI, initial jobless claims. But the big one is going to be the CPI and the PPI core. We don't have a lot of Fed data today, but we have speakers. We've got Dali, we've got Mester, we've got Raphael Bostic. They're going to be talking this week about clues on the economy. Europe, oh boy. Weighted disappointing inflation figures from China, gains in energy and insurance stocks, which are defensive, by the way, outweighed losers in minor and retail. Retail is starting to cool off a little bit. China, they closed slightly higher, giving up most gains as weak China inflation data overshadowed positive sentiment towards improvement between China and U.S. relations. Don't hold your breath. They're having some big issues with chip stocks. But to the rescue comes Janet Yellen, who, after having a 10-hour of meetings with senior Chinese officials over the past few days, as direct, productive, don't hold your breath, expressing optimism that her visit has advanced efforts to put the relationship on surer footing. We'll see how the Nasdaq reacts in the next couple hours on her surer footing, all right? because it's never done any good. Historically, these trips never work out positive. I'm telling you, they just don't work out well. I don't know why, but they don't. At the same time, the Nikkei closed lower today and hit a 1-month low. Healthcare stocks fell the most on Monday in Japan. Chip-related stocks underperformed. I was surprised. Underperformed. Look for a little more chip stocks to go down. In terms of pre-market move, Charles Schwab's got upgraded. Citizen Financial got downgraded. We don't have major earnings today, and I've already showed you we've got Wells Fargo on Friday. We got Citibank. We got JP Morgan and BlackRock. What else do you need, right? That's the big moves. Keep your eye on the bond market. I think the bond market's going to gain a little stability, especially as earnings are worse than expected. Here's what I think is going to happen. I think that over the past, well, not last week, but the past month, the A got a little too rosy, and a lot of these AI and chip stocks caused the Nasdaq to really, really go higher. I don't think earnings are going to give us a fair representation of that. I don't think earnings are going to represent that, and I think the economy is going to look like it's going to have to take a pause, a lot more pauses, but not because the markets are stable, because there's a higher chance of a recession. Janet Yellen just said it yesterday. I mean, after coming back from China, I mean, my God. So we got to be really, really, really careful right now. Now, let me just show you the sectors and show you what I'm looking at right now before we tie it all up, put it together, and move on. As you can see here, consumer discretionary is still the number one stock in light of earnings, which is pretty interesting. But technology, we're halfway down. Communication services, we're halfway down. Things are not looking as pretty. I think consumer discretionary has had its best days. I think industrial is not going to go much higher. I think basic materials is overdone. I think communication services is overdone. Energy, on the other hand, if it breaks above the 82, 83, could go higher. Financials could go higher if the banking data is not as bad, because they've been beaten down to hell because of bank news last quarter. They're just recovering now. Technology, I'm not happy about. Real estate, I think it depends on if the residential market is going to continue being hot and heavy, and according to analysts, they will be. So I like real estate right now, and I like financials, and I like energy. Healthcare, not so sure. And consumer staples, I think, are going to be ready to come up. Be careful with healthcare right now. They didn't have such positive news last week, and they could be a little more downside. But I think consumer staples is actually done, and I think it's going to start coming up in the next couple of weeks. So if I was a betting man, I would be betting right now on financials, on energy, on real estate. I really like real estate right now and financial. The two sectors that I would be bullish on would be real estate and financial right now. Technology, consumer discretionary, not feeling it at all. I think they're gonna top out right now. Communication, they're already losing momentum. So unless there's a new catalyst ahead of earnings that can stimulate AI, I just don't see it. Remember, markets, it's like a dangling of a carrot. The markets have to prepare for something in the future, and right now all we have is the CPI, which I know is not going to be amazing, and that's not going to be really tech sensitive, and then earnings starting out on bank stocks. So I would be focused more on the financial and real estate sector and not technology. I think this is not the time for technology to shine. Now, before I let you guys go, I've got something important for you, and keep your eye on the Telegram channel, because I'll be sending you my earnings report. I'll be sending you my implied volatility report for the week, and I'll be sending you my hit list. They're all coming your way on the Telegram channel. Go to rogerscott.com/Telegram, and you'll get all of that, including this video, the minute I release it, because I'm the one that posts it on Telegram nice and early in the morning. Now, folks, I've been working with a private group of 92 beta testers, perfecting a special type of software, a software that's so powerful it's able to track exactly when big money, big Wall Street money, is likely to flood into a stock at any time. And the track record of this new system on live trades, well, it's been like 86% accurate. I gotta tell you. Matter of fact, last week we closed out UAL for almost 30% gain. We've nailed 24 out of 28 trades. That's right, 24 out of 28 trades. I'm patting myself on the back. With an average return of winners and losers of 16% on your money every 5 days. Not bad. How would you like to make 16% in 5 days? I mean, I don't know if I could repeat it, but that's crazy. I'm convinced this new software will change the game for retail traders worldwide. I'm so excited about it, I can't even sit here. And I just filed a patent for it. I mean, this thing is cool. So if you're getting in front of what could be some of the biggest Wall Street moves, and if you're interested in it, there's nothing else to do but follow the link below this video. Get all the free details now. It's juicy. It's red hot. You need this. And again, I filed a patent for it. 86% win rate, an average of 16% return, including winners and losers after 5 days. You've got to get your grubby paws on this. Follow the link below. Check it out. And if you're in the Telegram or the YouTube channel, you will see a link for it there too, right below the video. Make sure to like our channel, subscribe to our channel on YouTube, like our videos, join our Telegram group, and most importantly, send me feedback. Support@marketgeeks.com. Have a hell of a week, and I'll see you later. Bye.